Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. This market right now continues to be the story of two bearish pitchforks and possibly an influential neckline extension. The first bearish pitchfork is a dark blue breach thrice and repaired, possibly thrice, early February to early March bearish shift pitchfork. We're right now a little above the dark blue lower time, currently at 296.65, as well as within a small band of congestion between 301.55 to 303.45. The second pitchfork is the more recent and larger bright red early February to late April bearish Andrews pitchfork. On this one, the market is right now just above the declining middle time, currently 299.40. And there are the two moving averages, or should I say there were the two moving averages. The first is the short medium moving average, currently at 345.20, which runs just under the dark blue upper time, currently at 351.65, and which 6 weeks ago, and on occasion since, helped along with the upper time to cap the market with a horn top pattern back at the start of June. The second moving average had not seen the market touch it since November, so quite a long while. It's a slowly rising gold long moving average, currently at 333.50. This moving average, along with the short medium moving average, were the market's senior participants. However, 4 weeks ago, the market sliced down through the long moving average as it wasn't there. So we will have to look elsewhere for support ideas. And thus I said 4 weeks ago, and I quote, "We might have a possible whole of 2025 a very large double top pattern." Now this hasn't happened as yet, but it's worth considering and especially remembering. Thus, whilst they are not targets, we might have a primary potential down in the 263 even zone and a secondary harder to reach potential down in the 229 zone. End of quote. Now 4 weeks ago, prices pushed down below the key 325 to 320 support zone, then down through the next support zone between 309.90 to 310.80, made up from the May 2011 high at 309.90 and the 50% Fibonacci line, the May 24 to February 25 move at 310.80. And as I said 3 weeks ago, and I quote, "This now formalizes the targets below of a primary target down at 263 even and a secondary harder to reach, seemingly much harder to reach target X1 down at 229 even." End of quote. We carried on pushing lower down through a small congestion zone between 301.5 to 303.40, as well as the rising purple neckline, currently 304.40 of the small August to October 2024 head and shoulders continuation pattern, until we hit 2 weeks ago, and again last week, what I called 3 weeks ago, and I quote, "the beginning of a various stratified supports from the September 2011 high at 299.90, quite widely spaced, I have to say, until the congestion at 252.20, end of quote. It is here where the prices finally slowed and stopped, and over Thursday and Friday last week, and again over yesterday, turned back upwards, back up over the dark blue lower time, the bright red middle time, to slow down at the purple neckline extension, but this time from below. Finally, there's something else I'd like to look at here, and for this I am indebted to Ray Bradbury for asking me about New York coffee 18 weeks ago, and I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on the monthly longer term charts, I noticed a pattern that had not been immediately obvious to me at the start of 2025 when I last reviewed the longer term charts. It is a multi-year 2012 to 2024 very large reverse head and shoulders bottom, a bright red neckline on my chart, currently at 275.20. The break higher over this neckline had already reached its primary target, but there was a secondary harder to reach, much harder to reach target X, up in the 433.35 area. What was interesting about this secondary target is that nearby is the next 100% projected Fibonacci line, here at 433.75, quite close in the scheme of things. Prices did indeed turn lower at this key combination of the 100% projected Fibonacci line and target X at 433.35, dropping down through and closing below the important 50% projected Fibonacci line at 347.20. Thus, prices for the first time in May closed back down below the dark blue upper time, currently at 382.60. And that's of the interesting 2019 to 2023 bullish Andrews pitchfork. Since then we have dropped down further below the dark blue middle time, which is currently at 306.90. And in July we've dropped down, but so far rejected the bright red neckline. It'll be interesting now to see the market's longer term reaction to this bright red neckline below. London coffee. Towards the end of May, the market breached and then broke down through what was a large, shallow bull channel. Prices carried on lower, pushing down through the 50% Fibonacci line of the May 24 to February 25 move at 45.55, sorry, my apologies, as well as the June 24 high at 43.95. I said of this bearish pressure 11 weeks ago, and I quote, "They now have the overhang of the market from roughly 5,300 up to this year's high at 58.49, sitting above," end of quote. Well, we now not only have the overhang pressing lower, but also the impactful force of the break below the shallow large bull channel. Thus, for such a break low, we have a primary target down at 41.64, reached 5 Fridays ago, and a secondary harder to reach target X1 down at the 35.15 zone, reached 3 weeks ago, and with a tertiary much harder to reach target X2 down in the 28.60 zone, which is still alive. So what do we have in the way? Well, I recently drew a bright green mid-February to late May bearish Andrews pitchfork. We did have the bright green lower time available as support for a while. It's currently at 35.01, but 4 weeks ago prices pushed and closed below it, though we have seen a resurgence today back up, or yesterday back up over it. We have in the meantime also pushed below a pair of interesting 50% Fibonacci lines. The first one from the November 21 to February 25 move at 38.08, and the second 50% Fibonacci line is from the May 21 to February 25 move at 36.49. It was, as I said 6 weeks ago, and I quote, "If we manage to break the August 24 low and the congestion that is just above it, then I am not sure how strong these 50% Fibonacci lines below will be," end of quote. And that became the reality, as they are now resistances, though I'm not sure how good they will be as resistances now. I also added 3 weeks ago, and I quote, "We have some congestion at 35.53, but I think the move down towards target X1 may be on the cards. Then we have a fairly free zone below that down to the combination of the January 24 high and May 24 low, both in the 32.59 to 32.61 zone," end of quote. This zone between 32.59 to 32.61, quite narrow, well, it seems to have halted the decline, and we've seen a pull back up again Monday, though it was capped by some congestion at 35.53. Is this enough on the downside? Well, we have some congestion down here from January to February 24 in this zone, but I am not so sure, as the bearish pressure is quite large. And one day, even 1.5, 2, 3 days, turning higher, however good it may be, well, that's not enough. However, if on the other hand we have some follow through higher this week, and we've started to today well, but not so good now, if we have some follow through higher this week, higher that we might have a weekly key reversal up, then I might consider it. For that to happen, we need to have this week's action exceed 37.07, and then, and only then, close on Friday over 36.77. This is now something I would now look out for this week. Even then, it could just be a dead cat bounce, so caution above all else.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.